Hurricane Harvey is having a huge impact on trading in gasoline this week, also in gasoline production. Normally when hurricanes hit the coast of North America, they tend to travel inland fairly quickly and dissipate. This time the hurricane has remained stuck basically over the Gulf Coast, dumping torrential amounts of rain down on the areas in Texas, and now moving into Louisiana and shutting in refining production. It's now raised the prospect that we could have a surplus of crude oil and a shortage of gasoline and other refined products due to bottlenecks cropping up in the system. Not only is it the fact that a large number of major U.S. refineries, a lot of which are on the Gulf Coast, have been shut in for the storm and may remain shut in a little longer than usual because the storm has hung around for several days. On top of that, there's the issue of transportation. How do you get material in and out of these refineries? Anyways, a number of major ports are closed, pipelines are closed, roads are underwater, so there's quite an issue here. And because of that, we've seen quite a spike in gasoline prices this week. Today alone, for example, we have gasoline at one point is currently up about 12 cents or 6.2% on the day in the near contract. And here's the near contract for September. We can see this real spike up in the last few days as the damage from the hurricane has become clearer and clearer. However, as is often the case with major storms, once this blows through, then people will be working to get the refineries back up online. One potentially okay thing out of this is that at least we are heading into the time when the refineries retool and take downtime anyways, where the Labor Day brings the end of summer driving season and people start retooling and shifting over to production of heating oil for the winter in terms of refineries. So that's something important to remember as well. The industry could bounce back relatively quickly, but the short term there definitely does look like there's a squeeze on in the market. When we come down here and look at gasoline prices, it's quite telling. The September contract has spiked up to 189. However, the October contract is at 165. November 152, December 147, and January 146. The cash contract is sitting at 175. 175 is a key level that for the gasoline contract that hasn't been breached since September of 2009. So in terms of the cash contract, we're right at a major high, and we are getting these spikes in the short-term contract, but at the same time we are getting overbought, and it's so far just the one contract that's moving. So what do we expect to see potentially over the longer term is we could get a reversal or some kind of averaging out process. Whether that involves the near-term contract coming back down or some of the out months coming back up remains to be seen. But one thing to remember is that this markets, when you looked at multiple contracts going out, reflects what does the street think the price will be 1 and 2 and 3 and 4 and 5 months from now. And currently, this downward slopingness is what's called backwardation, and this does expect that the street is expecting the gasoline price to fall over the longer term back down to some kind of an average. It's also important to remember we are in the seasonally weaker time of the year for gasoline. Even if we do get a short-term squeeze after summer driving season ends, the peak demand season is over. Demand should drop off, and we could see the price come back off in the coming months.